Welcome back. Over the past few weeks, we've received numerous requests asking us to do a video on where do you start your investment journey? What are the options available to them? What are the advantages and disadvantages of some of these options? So we decided to create this two-part series wherein for part one, which was going to be this episode, we're going to speak about the basics of investing, saving, active versus passive investing, risks, so on and so forth. There's going to be another episode which is going to be part two, and I'll link it in the description below, which will speak about stocks, dividend versus growth stocks, ETFs, mutual funds, etc. So let's say you have $10,000 today and you're looking for options on what you can do with the $10,000 you have. For starters' sake, we'll look at four options. Option one, you put the money in your checking account and leave it there. Option two, well, you don't trust the bank, so you put the money, withdraw it from the ATM, and put it under your mattress. Option three, you put your money in a high interest savings account. And option four, you invest it. And let's try to look at how this is all going to change after a period of 10 years. So in option one, in which you had money in a checking account which was giving you 0% interest, you have exactly $10,000 today, absolutely no change. As far as money under the mattress is concerned, even this does not change. You have exactly $10,000. The third option was the high interest savings account. Well, this is a little better. You have about $12,211, and I've assumed 2% rate of interest over a period of these 10 years. And eventually, you look at investing, and I've assumed that if you get close to 6%, you'll end up with $18,193, which means a gain of $8,193 over a space of 10 years. Just think about it. We'll look at another example. Let's say we've got two friends, Connor and Tommy. Scenario one, Connor starts investing from age 19, invests $2,000 every single year, and stops at age 26. Tommy, on the other hand, starts investing the same amount of money, that's $2,000 every year, but he starts when he is 27 years old, and he keeps on investing that amount till he's 65. Let's assume that the rate of return that they make every single year, hypothetically, is 10% every single year. Any guesses who'll end with more when they're about 65 years old? It's surprising, but it's actually Connor who'll end up with more money. He's going to end up with $1,035,160, while Tommy will end up with $883,000. What's fascinating is, although Tommy invested more of his savings, it is Connor who's got the benefit of really starting early. So the point I'm trying to drive home is compound interest is important, but starting to invest early is also really, really important because you're allowing your money to remain invested over a longer period of time, which results in higher growth when you look at overall returns. Okay, so now you've decided to invest. Are there factors to consider before you start investing? I would say two. First, look at your credit card debt. If you have any credit card debt, it's better to clear it because credit card companies typically charge from 10 to 20% of interest on outstanding balance. And that can add up to huge sums of money in the long run. Second, look at any emergency capital. Now, emergency capital is nothing but money that helps you keep afloat when anything unexpected happens. For instance, someone had a job and they lost it. They would rely on this emergency capital to keep them afloat during that time. It's highly recommended that you think about about 6 months worth of your expenses as emergency capital. Once you've ticked both these boxes, you're ready to invest. So now you've decided that you want to invest. What are your next steps? Where should you go? It all depends on what your expectations are, when you need the money, so on and so forth. So let's say you need the money after 5 or 6 months and you have about $20,000. In that case, it does not make sense to go for investing. Rather, you should go to a high interest savings account because in this case, your principal would be conserved. You'll still earn a little bit of interest, and at the end of 6 months or 8 months, you'll get slightly more than that 20,000. Next, let's say you are looking at a time horizon of 5 to 7 years. In this particular case, you can play around with a few options. One of the options that we'll consider in this episode today is Robo advisors. Now, Robo advisor, the term might seem pretty fancy, but it's essentially a specialized software which functions as some sort of an investment manager, but your money is invested kind of automatically. Now, how the money is invested largely depends on the options that you choose. So most of the times these robo advisors, they're going to ask you a lot of questions based on your lifestyle, income, risk appetite, preferences, and a host of other parameters. And based on those responses, they suggest portfolios to you. And one of the key advantages that I think that a robo advisor presents in today's scenario is fees. Robo advisors are definitely cheaper than individual human financial advisors. And one of the key reasons is that here we are talking about an algorithm that is doing investment for you. So in this episode, we'll look at a few key robo advisors that are out in the market today so that you have a better idea of where to go to if you are looking at making a financial decision. So we'll speak about 3 robo advisors. We'll start with Wealthfront, which is one of the best overall, and its expertise lies in goal settings. It offers the full package of goal setting, planning, banking, and investing in an elegant, user-friendly platform. If you're looking for financial guidance and don't require it to come from a human, Wealthfront is it. It offers fully digital investing at a very competitive price. Its goal setting and planning technology is excellent and should serve as a model for other robo advisors to emulate. It is so good. The next one is Betterment. Now, it's one of the pioneers in the robo advisory industry and is one of the first to use the technology to recommend a portfolio and to automate the investment process. Over the years since its founding in 2008, the firm has added additional asset classes and cash management, making it one of the top choices for beginners. Additionally, it also offers tax loss harvesting for all accounts, no matter the size. It also has a range of checking and saving account options. And finally, we look at Wealthsimple, which provides world-class long-term investment management with no account minimums. And they invest your money in a diversified portfolio of exchange-traded funds or ETFs that focus on low-cost, index-based funds. So this enables the development of a portfolio that's invested in thousands of different companies and different sectors around the globe. One of their unique features is automatic rebalancing, dividend reinvesting, and tax loss harvesting. In addition, their customer service is really good. So this can also be an exceptional platform, particularly for new and small investors who historically have been unable to afford access to these services for whatever the reasons might be, such as say fees or too complicated rules and regulations. Okay, so you might actually come to us and say, well, all this is great, but I want to invest in stocks. So for that, we are coming up with another video, and that video is going to specifically speak about dividend and growth stocks, differences between ETFs and mutual funds, where should you go, what should be your investing strategies, fees, some of the tax implications, advantages and disadvantages of each. So be on the lookout for the next video from Investor Diaries. And if you have any other suggestions, feel free to let us know in the comment section below. Till the next video, take care. Thank you.